Hey everyone, welcome back to the channel, your number one source for income-oriented investing. And in today's video, I want to talk to you about all these new single stock covered call ETFs that are coming out, right? So on the US side, of course, you have Yield Max, you have Curve, Roundhill is coming out with a whole lineup of them, I believe, as well. They're not out yet. On the Canadian side, you have Purpose. They got 7 of them, right? They have Nvidia, Tesla's their most popular one. Amazon, Google, etc., etc. They all have 25% leverage, and now Harvest, like you've seen from my latest video, has launched their own series of single stock covered call ETFs. They have unleveraged versions, leveraged versions, right? They came out with 4 so far: Microsoft, Amazon, Eli Lilly, and Nvidia. So in this video, I just really want to focus on giving you my important points to remember if you're thinking about investing in these. If you already have some of these in your portfolio as an income investor, there's certain points or very important things I think you should remember and understand before you invest in these, so you're not disappointed later on. So that's what I'm going to focus on first, and in the second half, I'm going to tell you really my opinion and how I'm going to play these funds. Am I going to invest in any? Which ones I'm going to invest in why, what I look at in particular, and my strategy that I'm going to be using on these. So when it comes to important things to remember about these single stock covered call ETFs, whether they're leveraged or unleveraged, you have to remember that you are really investing in one stock, in one company, that is. So if you're investing in the Tesla one with covered calls or the Nvidia one with covered calls, you're really investing in that stock, right? So you have to really understand that company and like that company because you're really investing in that company. Yes, there's a covered call strategy on it, but the ETF really holds one asset, that particular stock. So in my opinion, it's very important that you understand the stock, you like the stock, you are obviously bullish on the stock, or you think it's going to go up, or you think that stock is a good investment, right? There's, believe it or not, very little difference between investing in Tesla stock and Tesla with covered calls. The asset is the same, the strategy is different, or the strategy of the ETF, that is, right? So second point, that's number one. Second point is these are going to have higher risk by nature, right? The performance is tied to only one stock. So the Tesla with covered calls, Nvidia with covered calls, etc., the performance is really going to be tied to only one stock. So just like buying one stock is more risky versus a diversified portfolio of stocks, this is the same thing. So you have to understand that these have higher risk than an S&P 500 with covered calls, NASDAQ 100 with covered calls. Definitely much higher risk because there is a single point of failure, that one particular company. You have to remember that. Number 3, this really goes with all covered call strategies. Really, you are giving up upside, share price upsides, share price appreciation of that stock if you're buying the covered call version, right? So remember that when you're looking at the stock itself versus the stock with covered calls, you are limiting or capping your upside just like any covered call strategy, but you are cushioning a little bit your downside with those covered calls. So you got to remember, you are giving up upside on the stock. So if you're really bullish on the stock, maybe you're probably better off buying Tesla alone or Nvidia alone. Just like if you're really bullish on the S&P 500, then you're probably going to be better off just buying the growth ETF or the passive index ETF rather than the S&P 500 with covered calls. Of course, I know we're income investors. Income is what we want, but I'm just saying that remember that you are giving up some upside. And this is where it's different from fund manager to fund manager, right? So I believe with the yield max ones, it's pretty obvious you're giving up more you're getting more yield, but you're giving up more upside than the curve ones, for example, right? So then you have Purpose and Harvest. I believe Purpose is writing a bit less covered calls. I think you're giving up a bit less upside with the Purpose ones than the Harvest ones, but the Harvest ones have a little bit more yield. So general rule of thumb, if you see higher yield with the same type of product with another provider, they're writing more calls. You're giving up more upside for that yield. So it's important you understand the covered call strategy and how much you're giving up between the providers. Next point is the behavior of these ETFs is going to be very easy to understand and track. And the best trick I could give you is if you're following them, you have a stock list app, a stock watch app, or whatever. Just put the covered call one and then or the stock like Nvidia or Tesla, and then put the covered call one under and see what it does every day. You'll notice quickly that just like a normal covered call strategy, during a good day, the covered call one is not going to go up as much in terms of percentage, but during a bad day, the covered call one goes down less, right? So that's a typical way they behave. It's not always perfect, especially when the funds are a bit newer. Some wonky stuff, you could always see some wonky, weird stuff happen if a fund hasn't been out for a long time. But generally speaking, that's how they will behave. So you have to understand the behavior. Remember that during a bad day, typically the covered call one will go down less because there's call premiums there that are propping up the net asset value. But during a really good day, that stock goes up 1 or 2 or 3%, the covered call one cannot go up that much, right? It's going to go up, but it's going to go up a lot less. That's the capping of the upside. Another thing you got to remember is that this, typically these are all, except for Roundhill, which I believe are going to be weekly distributions, are all monthly distributions on the covered call ones. The stock price will drop every single month on every X date. So on every X date, that's when the distribution gets removed from the net asset value of the ETF to give you the dividend, typically the next day or the next couple of days. So YTSL, for example, it's right now 30 cents a month. So on the X dividend date, the stock will drop by 30 cents plus whatever Tesla is doing that day. So you have to expect that. I still get messages from people saying, how come the stock just dropped 30 cents or 22 cents? Well, you're on the X date, right? So the dividend is coming from somewhere. The distribution, rather, is coming from the net asset value. So remember that, and this goes for everything, right? Everything with a dividend, by the way, just that because these have higher distributions, you could see it more. It's more pronounced. So remember that on the X date, the stock price will drop by the distribution, and then you'll get the dividend, right? Another thing is focus on the fees. You got to look at the fees because, especially on the U.S. side, I find the fees on these single stock ETFs are pretty high. On the Canadian side, I like them a lot better. They're pretty much 40 basis points, 0.40, whereas the Yield Max, I think they're 99 MER. So look at the fees, and remember that the leveraged ones will, on the Canadian side, obviously the MERs are going to be much higher because they have leverage costs, but the fees are the same. So management fees, I find them pretty high on the American side. You have an S&P or NASDAQ 100 covered call solution that have, a lot of them have lower fees than these single stock tickers. So those are the important points I feel you should understand and remember in case you have these or you're planning on investing on these. Now moving on to the second half. So guys, now I'm going to talk to you about how I'm going to be using these funds if I'm going to be investing in them. Remember that my portfolio is my portfolio. My objectives are completely different from yours. So I'm doing what's best for me. And these are my opinions. And this is just how I'm going to play them. Doesn't mean you should copy me or have the same opinion. That's fine. I'm just giving you how I feel really about these, what I'm going to do with these. So first thing I will say is that I will never have these as a core position in my portfolio. They're single stocks. They're more risky, like the reasons I talked about earlier. So that's number one. They're never going to be a core position. They're always going to be, if I get any, which I have just 2 for now, very small positions in my portfolio. And the real reason I want them or that I'm going to get them, me personally, is really to boost the overall yield of my portfolio. So I will probably be focusing on the ones that are a lot higher yield. Speaking of yield, I think for me, I really have to have at least minimum 15, but pretty much at least 16% yield, or else they're just not attractive to me, because why would I invest in a single stock ETF, leverage or not, to get 15, 12, 13, 14% yield? I'm not saying it's bad. I'm just giving you my opinion how I see it, when I could just invest in an HYLD or a QQCL, which have 12, 13% yield. So I got to have at least, if I'm going to take more risk, I got to have at least more reward. I got to have at least 15, 16% yield at the minimum. Another thing is, me personally here, I would only invest in a leverage version, right? A 25% leverage version. Unfortunately, in the US, there is none. That's why I don't have any. In the Canadian side, Purpose, they're all leveraged. Harvest has leverage and unleveraged versions. In my opinion, I would only invest in a leveraged one, 25% leverage, not a lot of leverage. And from what I see from these leverage covered call ETFs that have been out a while, leverage does help to offset the yield return trade-off, right? Whenever you're doing a covered call strategy on something, you are sacrificing growth or appreciation, price appreciation for that income. So that 25% leverage really helps reduce that performance gap. So personally, I would only invest, this is just me, in a leverage version one. Another thing that I'm going to be getting ready to do, or the way I want to play them, is just like having a regular stock, I am getting ready to average them down over time. So most likely, if I have one or two, I would only keep investing or add more to it to really dollar cost average. So only if I'm down maybe 5-10%, I got to be down 5 to 10% on them for me to add more. I wouldn't add more if I'm up. If I'm getting 20% yield like a YTSL and I'm up on the stock, I'm not going to be adding more. I'm going to wait for Tesla to drop. I have to be down at least 5 to 10% for me to add more. That's just how I'm going to play them. Another thing for me, which I really, really like, is great for my portfolio, is that these are very, very, very tax efficient for me as a non-resident. So remember, as a non-resident for tax purposes, Canadian non-resident, what I really want, this is really for my cash account, my non-registered, which most of my main portfolio is, I want mostly, if not all, capital gains in ROC. I don't want eligible dividends or foreign income. So a great thing, for example, the Tesla one, impossible. It has to be all capital gains in ROC because Tesla does not have a dividend. So this is really good for non-residents. So these are very tax efficient for me. I just wanted to point that out. That or maybe the Nvidia one or the Amazon one. So I think Nvidia has a tiny, tiny, tiny dividend. But if the single stock has no dividend, it's pretty much guaranteed that there's not going to be any foreign income or eligible dividends, right? There's no dividend. So it's all covered call income, which in Canada is capital gains and ROC. So on the US side, it's completely different. I'm not a tax expert on the US side. You're going to have to do your own research there. My guess is that most of it, some of it's going to be ordinary income. In Canada, it's different. In Canada, it's very tax efficient because options income is all classified capital gains. So most likely it's going to be all capital gains and ROC, which is good. So that's another thing. So that's it for me. That's how I'm going to play them. Again, I'm never going to make them a core position. I'm maybe add a couple to boost the overall yield of my portfolio. I'm only going to invest in leveraged ones, stocks that I actually like. I am going to be ready to dollar cost average them a little bit over time when they're down 5-10%. And I would only invest in a leverage one if I had the option. So hopefully this video was informative for you. Give me a thumbs up. I would really appreciate it. What's your opinion? How are you going to be adding these to your portfolio if you are going to be adding them? Do you have the same type of mindset and strategy like I'm going to be doing? Do you really like these? Are you just going to ignore them completely and just go with a diversified fund? Let me know in the comment section below and see you next time.